Welcome to today's Explainer. We're jumping right in to take a deep dive into Sumitomo Mitsui Financial Group, or SMFG. We're analyzing this financial giant at a truly fascinating moment, right as Japan undergoes a historic economic transition. This puts SMFG squarely at the epicenter of a massive global market shift.
Let's kick things off with a number that is going to serve as our macro hook today, a massive 34.4% year-over-year profit increase. Now, a jump like that isn't just some slight bump in the data. It's a tidal wave. When a bank of this sheer size sees its profits jump nearly 35%, it tells us that something fundamental has shifted in their underlying business environment. It's a huge deal, and it's the perfect starting point for our analysis.
To make sense of all this, we're going to follow a clear roadmap today. We'll start with the macro shift happening in Japan, zoom in to the financial performance and volatility, outline the company's strategic growth, weigh the bull and bear cases, and then wrap up with your final actionable takeaways. All right, Section 1, the Japanese macro shift and what it means to exit zero interest rates. So, for literally decades, Japan has been this wild global anomaly, completely defined by stagnant, zero, and even negative interest rates. But that is over. The Bank of Japan is finally normalizing their policy, and in this awakening environment, SMFG is a prime beneficiary. Think about it. When rates rise, banks simply make more money on the spread between deposits and loans. This massive structural shift is the engine driving this entire story.
Moving right along to Section 2, Financial Performance and Volatility. This is really a tale of two timelines.
Zooming out to the long term, the numbers are absolutely striking. For the fiscal year ending March 2026, SMFG delivered a record net profit of 1.583 trillion yen. Let that huge number sink in for a second. This was driven by two main forces: rate hikes expanding those lending margins we just talked about, and highly robust corporate borrowing demand inside Japan. It is literally the perfect storm for profitability. But here's where things get kind of messy in the short term. In Q1 of the 2027 fiscal year, net profit rose another 33% to 501.4 billion yen. You'd think the market would be popping champagne, right? Well, the stock actually faced a really choppy reaction because earnings per share missed expectations at 79.70 yen. This friction highlights some severe quarterly volatility. The macro tailwinds are undeniable for sure, but trading revenues are bouncing all over the place. You really have to be prepared for some wild price swings during earnings season. Now, despite that frustrating earnings miss, management is not sweating it. They remain highly confident and are actively maintaining their massive full-year profit forecast of 1.7 trillion yen. This sends a very clear signal to the market that they fully expect to make up the difference in the back half of the year, all as their core lending operations keep riding that new interest rate wave.
Which brings us to Section 3, Strategic Growth and Returns, or what we can call management's three pillars.
So what exactly is management doing with all this record capital? Well, their strategy essentially boils down to these three clear pillars: aggressively rewarding shareholders, expanding globally, and restructuring their portfolio. Let's look at how they're treating shareholders first.
For Pillar 1, they are definitely not hoarding this newfound cash. SMFG announced a massive 180 billion yen share buyback program, along with bumping up the Q4 dividend to 79 yen per share. On top of that, they're executing a 2-for-1 stock split on October 1st. That's a classic move to lower the share price, increase liquidity, and really broaden their base of everyday retail investors. Moving to Pillar 2, it's all about global ambition. We've seen tons of speculation lately around their U.S. partner Jefferies, and while a full takeover seems off the table for the moment, SMFG has drawn a very clear line in the sand. They want to double their global sales and trading revenue to 800 billion yen. They are aggressively shifting from a domestic lender into a true global financial powerhouse.
And finally, Pillar 3, portfolio restructuring. None of this works if you don't trim the fat. Kind of like carefully pruning a bonsai tree, management is actively divesting non-core assets to clear out balance sheet clutter. They are hyper-focusing on higher-margin lending with the ultimate goal of hitting a mid-teens return on equity. If they pull that off, that would be a total game-changer for how the market values this company. All right, Section 4, the bull versus bear case. Let's look at the market divergence. This is where things get fascinating because analysts are looking at the exact same data and coming to totally opposite conclusions. On the bullish side, firms like DBS are screaming buy, pointing to a dirt cheap 15 times valuation and spiking net interest income from those rate hikes. But on the bearish side, you've got Zacks and Weiss downgrading to a hold.
They're warning about that high volatility we mentioned, and they fear that these rate hikes could actually end up slowing down domestic loan growth. It's a classic Wall Street tug-of-war.
Now, the bull case is heavily punctuated by this $48 price target from DBS. To put that into perspective, the average analyst target sits way down around $29, and even that implies a healthy 15% upside from current levels. So if you believe the DBS thesis that SMFG is trading at a massive discount and that rate hikes will just keep padding the bottom line, then current prices look like an absolute steal.
Finally, Section 5, Final Actionable Takeaways, where we synthesize all of this.
So what should you actually take away from this explainer? Let's break it down into 3 key points. First, the Japan revival trade. If you believe Japan is finally leaving decades of deflation behind for good, SMFG is arguably the premier vehicle to play that macro shift. Second, tolerance for volatility. With the stock sitting around $25 recently, you definitely need a moderate risk tolerance to stomach those mixed quarterly earnings. And third, the right entry point. While the upside looks really healthy, you absolutely must watch the Bank of Japan's ongoing commentary like a hawk before you make a move.
As we wrap up today, I want to leave you with one final, absolutely crucial question to think about. Is this Japanese interest rate cycle a true long-term structural change that's going to elevate SMFJ for years to come? Or is it just a short-term windfall that the market is already fully priced in? How you answer that will completely dictate how you view the future of this financial giant. Thanks for joining me today, and keep questioning the data.